Good afternoon, everybody, and thank you for joining us. Before we get started, I just wanted to go over a few brief housekeeping matters. I would recommend that everybody in the upper right-hand corner of your screen make certain that you've selected the speaker view rather than the gallery view. It'll help you see whoever's speaking at the time and declutter your screen to a certain extent. The next thing I would want everyone to do is whenever a question comes up, I would recommend that you click on the question and answer button, which should be in the bottom middle of your screen. After you click on that button, you could type in a question. It will be visible to the panelists. And if we're unable to answer it during the course of our conversation today, one of the advisors will get back to you privately offline and answer those questions. And before we get started, just to introduce myself, my name is Michael Halkias. I'm a partner at MSPC and a member of MS Investment Partners. And we're very pleased today to welcome Dr. Apollo Lupescu. He's a vice president at Dimensional Fund Advisors. It's one of the premier investment managers in the world. In his role, he is responsible for communicating Dimensional's academic foundations and investment beliefs to financial professionals and individual investors across the world. He is considered the secretary of explaining stuff for Dimensional because he excels at delivering thought-provoking presentations in a clear and understandable way. Apollo's been with Dimensional for over 16 years, and prior to that, he taught at the University of California and had his own consulting firm. Apollo received his PhD in economics and finance from UC Santa Barbara. He has a BA in economics from Michigan State University, where he competed in and coached water polo. To get the ball rolling, I've prepared a few questions. I'm hoping that some of the people listening in will join us with additional questions for us to answer. Apollo, again, for joining us today. I wanted to start with a question about the market performance overall. One of the fundamental premises in investing is trying to get a sense of the market. We hear numbers on the news, we see them in the publications on the internet, but it's not really clear what measure investors should be using to make their investment decisions. In this month, you see the Dow Jones down 3% for the year, the S&P was up 5%, the NASDAQ is up 25%. Why are they all different? And what's the best way to gauge market performance as an investor?
Right. Well, hello, Michael, and thank you so much for the invitation to be here. Thanks to all of you for attending. I think it's a really important question because things are about to get even more interesting. And let me give you some background. So the idea is that how do you measure market performance has been with us for a long time. And the very first person to actually try to systematize this was Charles Dow way back in the 1800s, 1880s. And that's when he put 12 stocks together. He averaged them based on their price, and then he came up with the Dow Jones average. So the Dow Jones average has been around for the longest time, but it turns out that as popular and as widely followed the Dow Jones is, it's also the most flawed measure of market performance. Why? Because in the US market, there are about 3,000 companies that trade on the stock exchange, and the Dow only has 30. Only 30 companies out of 3,000, so a very limited set. And in fact, what's really interesting is that the three of the largest companies three out of the five largest companies in the U.S. market, namely Google, Facebook, and Amazon, they are not part of the Dow. So that makes it even more interesting. But the biggest flaw that we see with the Dow is that it's a price average. What it means is that you simply some of the largest holdings in the Dow are United Healthcare, Home Depot, Goldman Sachs, Visa, not because they're very, very large companies, but because their price is high. So to me, as a professional, I would say that the Dow is probably the measure that is least useful to professionals. The second measure is NASDAQ, which is simply what are the stocks that are traded on the stock exchange. And right now there are about 2,500 stocks on that exchange. And it is something that's called market weighted. It's capitalization weighted. In other words, the percentage that each company gets and its allocation in that index depends on the overall value of the company. So in this context, the largest companies in the U.S. economy are also the largest companies in NASDAQ, which are Apple, Amazon, Microsoft, Google, and Facebook. So these are the five largest ones, which are also in the NASDAQ. But here's the thing, Michael, that's amazing. Right now, about 44% of the return of NASDAQ is driven by these five companies. So you have 2,500 in that index, and almost half of the return on the index is driven by 5 stocks. So Nasdaq is a really interesting metric because it's driven so much by a handful of very large companies. S&P is similarly a market capitalization index, meaning like the value of the company really matters in terms of what percentage does it get in the index. But because it incorporates stocks that not only trade on NASDAQ, but also on New York Stock Exchange and other stock exchanges, the percentage in these top 5 is lower, which is about half. It's about 22%, but even then is great. So to me, if you want to know how is the market doing, I would say the S&P 500 is a good metric because these 500 companies represent about 90%. So if you do watch the news, I would focus more on the S&P because it's much more comprehensive. But with that being said, there are about 2,000 other smaller companies not part of the market, but they're part of an index called Russell 2000. And so if you want to get a picture of how the market's doing as a whole, you'd have to somehow look both at the S&P 500 as well as the Russell. Those are roughly all the companies that trade in the U.S. stock market.
Thanks for that, Apollo. Just to switch gears slightly, one of the biggest questions investors had before coronavirus really, stole the front page was about how they should anticipate the impacts from the upcoming election. The election is coming. November's right around the corner. The country seems to get more and more polarized as every day passes. What are your thoughts about what impacts the presidential election will have on the market? What are the implications of having either a new Trump administration or an incoming Democratic administration? Are there actions that investors should be taking right now to prepare for that eventuality?
It's such an important question. First of all, it's very timely because we're in the middle of a convention. We had one last week, and it's certainly on people's minds. So, Michael, the way that I look at it, I start with something that's been so interesting for me to observe. This question, as to the point that he made, has been on the forefront of investors' mind for a while now. And going back to the beginning of the year, every time this conversation came about, and in fact, for the last few years, what it became very obvious is that it's a very emotional side, that it has a very emotional side, that it touches on people's identity and core beliefs. And quite often what I found is that the attitudes that people have towards the economy or the market are lined up with their political views. So the first thing that I will tell you, in this environment that we're in right now, which is so charged and polarized, what it seems different, but one thing that is so important for everybody to understand is that it carries a lot of emotions, and there's a big behavioral component to investing. And what I would encourage all of you is to work with Michael and the team and make sure that he disentangle the emotional side from actual investment decisions. That they're not really based on emotion, but some analysis and number crunching. So we looked at that issue. We looked at whether or not this is a presidential election, whether or not have a new administration, whether or not tax policies will really matter. And we looked at all of these, and I'll touch on them, but I'll give you the punchline first. And the punchline is, when you look at all of these, there doesn't seem to be an indication that an investor should make a move in their portfolio because of elections and politics. What we see is that elections and politics, they do have some very short-term, they create some short-term fluctuations in the market. If you remember back in 2016, the night before the election, the market dropped about 5% as the news came in that President Trump was elected. And then the next day ended up being up about 1%. So on the short term, I think there is some noise trading around the election. But when you actually take a more rigorous look at these 3 questions, does it matter that it's an election year? Is that different for an investor being an election year? That's the first question to look at. The second one, having a Republican or a Democrat in office, how much does it matter in terms of what you get as an investor in the market? And number 3, when you look at these changing tax policies or other policies that an administration might implement, again, what should investors expect? So I'll touch on these 3, and I'll start with the first one because it's a very interesting one. Being in an election year, how much does it matter to investors? So over the course of the 90 years that we have good data in the U.S. stock market, the average growth per year in the stock market has been somewhere in the average of about 9 to 10% per year. That's the average over the long run in the US market. Now, in these 93 years of good data that we have on the market, what we have had are 23 different election years. 23 different election years in which you can look at the data and ask, what did the market do during these election years? And if we're going to look at the average, we're just going to look at the average of these 23 election years. The question is, how different is the average? How much lower, how much higher is it than the long-term average? And what we see is that for the 23 different election years, the average of them is pretty much spot on the long-term trend. So there is no real difference in returns in the market when it comes to being an election year by itself. Now, average means that sometimes the market goes up and sometimes it goes down. So if you split it in that way, what you see is that 19, the overwhelming preponderance of the time, the market went up in an election year, but 4 out of the 23 years, it went down. So I thought it might be interesting to see what can we learn if we look at the 4 years when the market did go down in an election year. What information is there? So the first time that we saw this happening was back in 1932. When the market dropped 8% during that election year. And I thought, okay, we had an election year, but what else was going on in the world just about that time? Well, we were still in the Great Depression. So yes, we did have an election, but we're also in the Great Depression. 8 years later, in 1940, once again, we saw that the market dropped about 10% in an election year. But if you remember, there was also the year when Germany invaded Europe, and it became obvious this is going to become a world war. And it took 60 years until the next time we saw a drop in the market in an election year. And that was in 2000. And yes, we did have an election, but at the same time, we also had, Pets.com and all the other tech firms that went bust about the same time. And the fourth year is obviously in 2008 with the great financial crisis when the market had a significant drop. So looking at this, when you look at an election year and you say, well, what can I learn? It seems to me, just as an observation, that every time the market went down in an election year, there were a lot bigger things going on in the world than the election itself that might have driven the market down that year. And even if you look 20, 30 years from now back at 2020, it's possible that we might look and say, yeah, we had an election, but we also had the coronavirus. What might have been the cause of that market drop? So knock on wood, I hope that's not going to be the case. But all I'm saying is that just because it's an election year, it doesn't necessarily mean that it will have either a positive or a negative impact. And in fact, if anything, it's more likely 19 out of the 23 times the market did go up in an election year. So the overwhelming majority of the time, the market does go up. But there are times when it also goes down. So on the first question, should it do something different because in an election year? Not at all. It doesn't at all. There's no indication in the data that you should do that. Now, what about if we have a Republican or a Democrat? And for that, I didn't go back to the 20s, but I rather went back from the year that I was born. I was born in 1969. And when I was born, President Richard Nixon was in office. And during the 5 years that he was in office, the market on average had a drop of about 3%. Now, those are the times of 1973, 74. There was a big economic downturn, the oil crisis. So there are big things happening, but the average for the 5 years of Richard Nixon's time in office, the market actually dropped. Now, followed that with the next 3 years, where on average, the market skyrocketed over 20% during the time of President Ford. And as you fast forward through all the presidents and you look at the average growth of the market, the average return of the market during the time that they were in office, what it kind of became clear just looking at this is that there is no clear indication that having a Republican or a Democrat is good for the markets. And in fact, I would go further and say that a president should receive neither credit nor blame for what the market did during their tenure. I would look at President George W. Bush. When you look at President George W. Bush, he walked in exactly as the .com bust was starting to unfold. 9 months in the tenure, 9/11 happened, And then he walked off at the very bottom of the great financial crisis. On the other hand, you had President Clinton, again, not a political statement, but it turns out that he presented over this great tech run, and talk about market timing, walked off just as just before he went bust. So to me, I don't think that a president should receive neither credit nor blame. There are a lot of other things happening in the world that they don't necessarily control. So having a Republican or a Democrat, it is not obvious to me that that would be a good or bad for the market. Now, you also hear today that perhaps, look, you have potentially if you do have a Democratic administration, it's possible that some of the tax policies would change. It's possible that maybe taxes might go up. Well, to begin with, let me start with just a comment: is that taxes it's an interesting topic because we've had a tax cut and it did benefit the corporations, and I happen to live in a state, California, that in fact it wasn't a tax cut, but it was a tax hike for me. And I think that's what's interesting is that you have to balance that, even if there's a tax, perhaps there are other things that might actually be better for business. For example, more clarity around tariffs, or whatever else might be the case. But to illustrate that very clearly, I'm going to again point out to two different administrations. When President George W. Bush came into office, one of the things that he did that I thought it was really remarkable is that he was very, very friendly toward the market, the stock market. He cut taxes towards long-term capital gains. Dividend taxes were cut, and it was a big boon for investors. And the expectation is that with a business-friendly president, with all these tax cuts towards investments, the market's going to run wild. And yet, during the 8 years that he was in office, the market lost over 4% per year. On the other hand, if you remember the headline, of Newsweek, which said we are all socialists now, when President Obama was elected, I think a lot of folks are afraid, well, this is going to be a disaster for the market because you have Obamacare and you have other more, government-oriented policies, and this is going to be terrible for the market. And yet, during the 8 years that he was in office, the market did remarkably well above the historical norm. So I would be cautious in drawing that. And to really see that in play, that the market is not really driven by politics, but much more by business forces. I think it's a great illustration to look at the last few years. And as an investor, you might have been actually excited to hear that we had a plan in place to support the local steel industry, domestic steel industry. And we have had tariffs put in place. And in that so that's great. And when you look at what happened at the company that carries the name of the industry, U.S. Steel, the question is, what happened to the company once the tariffs were put in place? And it's tempting to look and say, look, the tariffs were put in place here, and the stock kept going up. In reality, though, the tariffs were put in place here. And what happened was there was a jump in the price as the tariffs got implemented, but shortly after, the market forces drove the performance of the stock. And in fact, it's lost the majority of its value after the steel tariffs were announced. So you got to be careful that when you look at this and say, well, it's policy. Government are going to drive the market. Not really, a market needs come from the profits that they make. And while the government might matter to some degree, that the biggest contributor, the biggest driver of company profits, they have the competition, the strategy, how they execute the strategy, and that carries a lot more weight than who's in the White House and political forces. So once again, I would be cautious to draw too much inference on that. I don't think that whether we have a Republican or Democrat, it will be the main driver of the company, of the stock market performance. I think it's going to be much more, what is the company looking to do? And I'll tell you the good news, Michael. In the world we live in, In the world we live in, these companies will find a way to make money in whatever state of the world we're in. So they'll find a way. That's their job. That's what the CEOs do every day when they go to work. Is like, how do I get this company back to making money? And as an investor, you're just along for the ride.
Great. And again, I just like to remind everyone, if you have any questions, please, type it into the question and answer box on your screen. We would love to get some of your questions and discuss them. Apollo, we were just talking about how little, government forces tend to impact the market. But right now, with the decline in economic activity, the high unemployment rate, mainly due to the COVID crisis, the government and the Fed have deployed incredibly significant stimulus programs, and it's very likely there will be more stimulus to come. What was the impact on the market and the economy from these stimulus actions? What risks are these actions creating for further down the road? Particularly, are we worried about inflationary pressure, unsustainable levels of government debt? What's your take on that?
Right. So, so when we have a typical economic contraction in the U.S. economy, what happens is one of the three groups that generate economic activity, and that is the consumers being the largest one, companies, or the government. If they're cutting spending, and particularly consumers, which are the largest part, if they're cutting spending and they don't have as much income or something happens to consumers, that what happens is that they're buying less. And because they're buying less, firms are producing less, and there's this economic contraction. So what we've seen is right now, by the way, not only that we have the demand side crisis because consumers and companies are spending less, but we also have a supply side shock because companies just can't produce since workers are still kind of in the mode of getting back into full production. But the reason I'm saying is that the government stimulus, basically what they try to do is to inject some money in the economy because the consumers were so constrained. And the reality is that what they're trying to do is absolutely the right thing. At the time to implement such a measure was when the economy really hit the bottom. And in my view, that was something that was absolutely necessary, and it helped us. And it's a little bit like, if the house is on fire, let's not worry about the carpet. Let's put out the fire, and then we'll come back to that later. But what are some of the consequences that we might see from the stimulus package? Could there be inflation or national debt? So for that, I'll give you, let's start with the inflation piece. So inflation, this question actually came about maybe about 10 years ago when the Fed started deploying another program called quantitative easing. Once again, flooding a lot of money in the economy, and that was a program that they started running right after the great financial crisis in 08-09. And once again, people are wondering, will this lead to inflation because all this money is now in the economy? Well, here's the thing with inflation that all of you, I think every on the caller should it's a very important concept. If a company, let's say, making these pens, if this company produces pens and people place orders and they can produce these pens, well, that's the price they charge. Now, all of a sudden, let's say there's an influx of new money, so more people want to buy these pens. Well, at that point, if the company can still produce the pens without, it would still meeting demand and still meet demand based on the capacity that they have, there is no change in prices. And that's what we saw over the past 10 years, is that even as you had this money, the economy had enough capacity to produce without actually having in, and the economy. And that's where inflation comes from. It's too much money chasing too few goods. That's what inflation basically is. So we haven't seen that not only over the past 10 years, but for the past 35 years. And part of it, and I think the economic explanation, is the economy had enough capacity. And in fact, the big issue that came with the pandemic wasn't inflation. The big concern was the opposite, was deflation. Could there be that they're more money, so then the prices have to be dropped? And for people who are, more, I mean, even if people are not technical savvy, I think it's a pretty interesting website to look at, and it's done by the Federal Reserve. The reason I want to share this with you is to give you a sense of right now, when you look at market participants with all this spending, what is it that they anticipate inflation to be? So Federal Reserve has a branch in St. Louis, and what they do is they publish something called a 5-year break-even inflation rate. And as it says here, it's basically what the market participants expect inflation to be over the next 5 years on average. So we can go back 5 years or longer, but let's look over the past 5 years. What the market participants have expected is in between 1% and 2%, with an average of about 1.5%. Now, when this pandemic started and the recession started, what you see is that the biggest fear that market participants had was actually deflation, that there is no growth in prices, that the prices are going to be flat or even falling. And that is also a possibility right now. And we just don't know yet which one might come. But to me, what's interesting to see is that where we are right now in terms of expectations of inflation with all this stimulus is pretty much the same in line with what we've had for the past 5 years. So we don't see a big change in terms of market participants. We don't see a big expectation of inflation coming from these market participants. So again, we don't know what tomorrow, but at least from what the market's telling us, we don't see an expectation of inflation. My personal view is that if we were to see inflation, it is not because of the government stimulus. Because the government stimulus is just replacing some money to a lesser degree that people had. To me, the biggest one is the issues that we're having with the supply chains caused by the trade conflict that we have with other countries, particularly with China. And the reason I'm saying that is because if you have the supply chain gets broken and these companies cannot get products to the US. And right now you have shortages, anything from bicycles to anything. You go on Amazon, and it used to be that I would get it the same day. Now you have to wait a few days. That means that the supply chains are not as resilient. And in that respect, I think it kind of dents a bit the capacity of these firms to produce. So to me, that would be a bigger concern, not the stimulus, but much more so the trade wars. Now, with respect to the other issue that people are concerned, which is what about the debt? Can we repay this? Once again, the market sends us some signal. And the signal is that if the government wants to borrow, it has to offer an interest rate that an investor is willing to accept. And if the investors believe that there's risk associated with that, they just won't accept that interest rate. And to give you just a concrete example on that, if you look, if of a loan, we get it back in 10 years and we get interest in that time. What you see right now is that investors are willing to accept 0.7% over the next 10 years on their money in these U.S. government bonds. Now, this is most people believe that that this is a safe bet because the government has never missed an interest payment or a principal repayment. But if you are a private corporation, would you pay the same interest rate? And the answer is no. Even Apple has to pay twice as much, more than twice as much, for the same type of bond. And the reason for that is, see, it's a little bit riskier to buy an Apple bond than a U.S. government bond. Clorox, we know that we're going to use it for anywhere for the next 10 years, and you still have to pay a little bit more on these bonds. And the riskier the investment, you buy Starbucks, well, it goes up to 2.5 or so. And if you want Southwest Airlines, by the way, you can get 5% on these bonds. And I'll talk about Nordstrom, which is 8.5%. So you can always get a little bit more, but it's a compensation for maybe taking a little bit more default risk. And to me, what this indicates here, this very low interest rate that the U.S. government is saying is that market participants voting billions of dollars, I know but I have no doubt that the government will. So in that respect, once again, is that it's going to be okay.
Now, Apollo, something that you've talked about already a few times is how unprecedented today's market is, how unprecedented the current events are between the economic issues that have been caused by the coronavirus, the large-scale unemployment. Can you give us some perspective how we can look to the past for relevant guidance and lessons that'll help us cope with the current situation?
Yeah, no, it's a really important one because you do see there's so much going on and people are uncomfortable. And it's not common that we have both a demand side crisis and a supply side crisis. That's what makes this different. The typical economic downturn, it's only a demand side. That happens every 10 years. Having a supply and demand, that to me is the crux. And we've only seen it about 3 times that I can think of in economics textbooks. And the first one was actually about 100 years ago during the pandemic. Because the 1918 pandemic, the Spanish flu, when I first heard about it, it's like, well, that was 100 years ago. We can't just relate. The world is very different back then. It's nothing like we have today. So in my mind, it was like, let's set that off because we can't learn anything from it. And it turns out that we can learn something from that. And the more I dug into it, the more I realized that, in some ways it is eerily similar. In fact, if you look at the way that we dealt with it as a country was not vastly different than we're doing today. Basically, we shut down schools. We shut down churches and all public gatherings, and it started in the Northwest, and every city had the ability to do their own thing, and you had the South and the Midwest, and people were kind of being told, hey, go ahead and keep the window open, and the advice that we got from the government, not vastly different. Stay away from sick people, don't put your hands in your mouth and wash your hands and don't spit on the floor. Okay, maybe that's kind of past, but the point is that it's very similar that we went through back then as a country, and even like what we see right now with the mask, the big debate about masks. Should you wear a mask or not wear a mask? Well, it turns out that it's not unique to us. Back in those days, you had an anti-mask meeting. On the other hand, you had people on the train platform saying, wear a mask or go to jail. The police was there to enforce the mask, as this young gentleman here on the left is trying to tell the couple, one of you has the mask, but the other one doesn't, so put it on. But even in terms of what we have today is like, well, we have online shopping and we have streaming services and we have a way to communicate through Zoom. Again, it's remarkable. Back in those days, no internet, but you can stay at home and shop by phone. And you get stuff delivered to you. You don't, theaters are closed. You can buy this device that the dog is staring into, and you can have, a great talent coming into your home. And by the way, if you're in quarantine, you're not isolated if you have a telephone. So again, very, very interesting how many similarities we have. And even in the way that we treated people, in the sense that we didn't have a treatment or vaccine back then the same way as today up to this point. Now, what's the lesson here? The lesson is that and it's a great paper that was published by 2 Fed economists and a PhD from MIT. And Michael, if anybody's interested, I can send it to you and you can forward it. Is that cities that actually took care of the issue, and back in those days, the quarantine lasted between 60 days and 120 days, the average being 90 days, pretty much like what we're seeing this time around. Cities that took care of it ended up better off economically than cities that didn't actually close for long enough and they didn't take it as seriously. And the main idea being that you can't really solve the economic situation until you take care of the health crisis. You can open the economy all you want. If people are not comfortable going out there and spending, they're just not going to do it. And particularly the higher earners, those are the ones that tend to pay more attention to this and be a little more afraid. And if they're not feeling comfortable, the economy is going to have a hard time recovering. The second lesson is be careful with the doom and gloom, because, that was 1819. 165,000 Americans died at a time when our population was a lot, I'm sorry, 615 or 675, more than 500,000 people died. So a lot of people died in those days. And yet, not only that we had a war to deal with back in those days, but what was interesting is what came afterwards. And what came afterwards wasn't a huge period of headaches and terrible times, but something that we know today as the Roaring 20s. When people went back to having a cocktail, so much so that prohibition came along, you had manufacturing really taken off. Cities came back to life in a big way, and as a whole is known as one of the most vibrant periods in American history. And I'm hoping that's what we'll see. The Roaring 2020s coming up this our way. But again, be careful, because we did come back out of that and perhaps stronger. This is a remarkable decade that we went after that pandemic in 18, 19. That was the first time. The second time we saw this supply and demand was World War II, because in World War II, 11% of the workforce was pulled away to participate and support the war effort. And again, there are some great lessons from that period that might be with us today. The first lesson is that we're really good at reallocating human capital, and what I mean by that is that there, at the time when all these folks were going to fight in the war, somebody had to build the ships, somebody had to continue the production lines, and women stepped in. And to me, it was a watershed moment when you saw Rosie the Riveter, because there was a realization that any job can be done by a man or a woman. And we have been inching towards that goal ever since. But also that not just reallocating human capital, but when you look at physical capital, in those days, if these companies couldn't sell cars, guess what they did? They made tanks. If they couldn't sell toys, they probably made bullets. And that's what we're seeing today as well. You have Ford and GM repurposing plants to make ventilators. You have distilleries brewing hand sanitizer instead of spirits. And that, to me, is an incredible testament to free markets. In free markets, companies will find a way to make money. And as an investor, you ought to be very careful not to get carried away with the doom and gloom. Very careful, because look at those days. 1936, you had the Olympics in Germany. When you saw Hitler presiding, you kind of know the way the world is going. In 1937, the U.S. stock market, the S&P, dropped by 35%, almost as much as the Great Financial Crisis. And there was a rebound in 38, but 39, 40, 41. By the time the U.S. entered the war, 4 out of the last 5 years in the market were negative. So picture yourself, December 1941, the US just entered the war. 4 out of the last 5 years, you've lost your shirt in the market. You're looking out there and saying, boy, this can be good. Millions of people are dying. Cities are being destroyed. Stock market seems like the worst idea ever. How can you even possibly think about investing at a time like this? And what was remarkable is that during the full years of war, the U.S. stock market in every single year, not only that it went up by a significantly greater percentage than the long-term average. So to me, what's absolutely remarkable is that the U.S. stock market, during the darkest days of our parents' generation, really did remarkably well. $1 invested at the beginning of the war would have pretty much doubled by the end of World War II. So it's be careful when things look so wary and terrible, that you don't get carried away too much, because these companies, as I said over and over, in free markets, they will find a way to make money. That's just what's going to be the case. And that's kind of what is likely to happen this time around as well. So we had the Spanish flu, World War II. The third one is the 1973-74 oil embargo when, because of the conflict in the Middle East and to show their displeasure with the U.S. policy, these OPEC, the Organization of Petroleum Exporting Countries, imposed an oil embargo against the U.S., which some of you might remember led to great pain. There were lines and lines. Gasoline was not available. So as a whole, it really put a big stop to the growth of the U.S. economy. So imagine yourself being in this car, waiting there for hours and not having gas. How would you have felt back then? It was a terrible time. But there are lessons that are with us today. And the first lesson is that once a crisis like this happens, it is likely that we will change. It is likely that there will be changes. And back then, as soon as the crisis is over, we passed a law requiring better fuel efficiency for cars. So if you're somebody who loved the gas guzzler, well, you might not have been happy. Others were pretty happy if they, you know, from an environment perspective and so forth. But the point is that we did change, and we'll change this time around too. I'm actually, like, if you look at companies right now, they're reassessing their work from home and remote working versus what it was a couple of years ago. But the other big change is that we looked at oil not only as a commodity, but from a national security perspective. And now we are the largest oil producing country in the world. And it is, you know, quite possible that after this, as all these supply chains come under scrutiny, not only that they're not as reliable, but also, again, from a national security perspective, perhaps there will be a move of production towards the U.S., which might mean the rebirth of U.S. manufacturing. We'll never know, but we hear stories right now, anecdotal stories that these supply chains are not as reliable as we thought, and resilient as we thought. So perhaps domestic production might make sense. So it is maybe 10 years, 20 years from now, we'll look back and say, this was the impetus, the trigger for the growth of U.S. manufacturing. So all those, I think, are lessons that we learn, and if anything, it gives us a little just caution not to see things too darkly, because perhaps there are other times when things look as bleak as they do today, and we emerge stronger.
Apollo, I'd like to go back to the very first question that you answered. And in that question, we were talking about just a handful of very large technology companies. We're talking about Facebook, Amazon, Apple, Microsoft, and Google, you know, their parent company being Alphabet. You know, they are responsible for the largest portion of the run up in the NASDAQ. And there are a lot of investors who believe that these companies will dominate the technology market for years to come. And given their scale, given their performance, should investors be focusing on these very, very large technology companies?
Right, and that's a really good question. I think that when you look at it, I think that looking at your portfolios and looking at just, you know, diversified portfolios, they did have those companies. So people had them, and the question now is, should you focus more on these companies than you had before because of what you said? So they were part of the portfolio, didn't miss out, but is that maybe time to put even more money into those? And when we looked at this, there are three things that I think it would lead me to believe that in fact, you still need to have a very diversified portfolio where you're not putting too much money into these companies. Be careful not to oversize their presence. What are the three reasons? The first one is that whenever a company gets very big, they also tend to invite scrutiny. And if you remember, not too long ago, a few weeks ago, you know, the heads of the four families had to testify by video, and the government is on their heels, and it is kind of taking a lot closer look at their business activities. And it kind of made me think that the companies, there are five of them. Well, how come only four are here? What happened to the fifth one? And then I remembered, well, the fifth one was is still Microsoft, and Microsoft had its day. That was about 20 years ago, and just after that, as I was looking at this, I saw an interview with Bill Gates, and he point blank, the government interference in their business and scrutiny was such a distraction that they were working on something called Windows Mobile for cell phones. And they just couldn't get it done because of the distraction of the government inquiry into Microsoft. And obviously they missed the boat. We're using an Apple phone right now rather than a Microsoft device. But it's interesting that at the time, if you look at January 1st of 2020, of 2000, when just about the time when this is unfolding, the price of Microsoft stock was about $37. And then you look at the end of the decade, this is 10 years later, at the end of 2009, that went down to 24. So over a decade, they lost a third of their of the value of Microsoft. So to me, you got to be careful, because I don't know what's going to happen now, but I can, kind of tell you a little bit that from the experience, that these companies, the bigger they get, there is more risk coming maybe from regulatory and government oversight and scrutiny. The second reason is that these companies, because they are so successful, they are now extremely expensive to buy as an investor. If you open your phone and you look at, how much does it cost you to buy $1 of earnings in Amazon? It's called price earnings, or P ratio. Well, to buy Amazon right now, I think it's over $120 to buy one single dollar of earnings. If you were to buy Pfizer or Intel, it's $10 to $15. So it's not just that you own it, but boy, you're paying a lot. You could be getting a lot, and there are better deals out there. And number three is to kind of really dive into it. The question that he asked is that once a company becomes dominant, what will happen to that company? And we've looked at this going back to the 1930s. These companies that get big, what happens to them? And when you look at the top 10 companies in the U.S. market over decades, and you see, once you get there, do those companies stay a large dominant companies over time? And the answer is pretty overwhelmingly yes. AT&T was the largest stock in the market for 40 years, and then it was in the top 4 for another 30. So overall, over the last 7 years, they've been in the top 4 or 5 companies. General Electric was there for 90 years, up until about 10 years ago. And they were the technology companies of the day. Telephony was a big deal. General Electric making all these things that at the time were super high tech. DuPont, the chemical company. So a lot of things that were high tech back then, they continue to stay dominant over time. Look at IBM. IBM was there for so long. So we have seen some of these companies that get big stay big. The question is, well, is it possible that Apple, Microsoft, Amazon, could they continue to stay as big? And the answer is absolutely possible. Yeah, it's quite likely, looking at what happened in the past. However, the question should be a little bit different than that. The question shouldn't be, will these companies be dominant? But the question should be, will they be great investments once they got to this point? And when you look historically at companies after they join the top 10 list, what you see is that over 3 years, over the short run, they do tend to outperform the market. This shows you what is their return relative to the market. So in this case, they outperform by 0.7% per year over the next 3 years after they join. So, and by the way, before they join, their returns are fantastic. But what happens if you give it more time? Well, what you see is that they run out of steam, either because it's a lot harder to grow. Think about how easy it is for Amazon, Google, Facebook to double in size, or because they become mature companies and the return they have to give investors, is not as large because the cost of capital is lower. And what we see is over 5 years, they tend to underperform the market. And when you look at 10 years, they tend to significantly underperform the market. So, in that respect, it is possible, as I said, that Amazon and all these companies, the top 5, the pharma stocks, as I call them, it's possible that they will continue to stay dominant. But my view as an investor, I'd like to find the next Amazon, the next Apple, because they've had great returns. I had them. I'm happy with that, but I also want to make sure that I capture the next Apple, the next Facebook, the next Microsoft. So that would be kind of my view on that.
So further to that attempt to find the next Apple, find the next Facebook, every downturn also generates some opportunities. Do you
Right.
see any sectors or companies that you believe are well positioned to perform through the tail end of the crisis or after the crisis is over?
Right. So it's interesting because I was looking at the the slideshow before the event started, and it was a slide about the new economy versus the old economy, and which did better? Was it Apple or Tractor Supply? It turns out Tractor Supply did better. Here's the view that I have. Is that every investor out there is looking for these opportunities, and by the time you get to buy them, the price was bid up. So the idea is to try to get something while the price is still good. So the way that I look at it is a little bit different. The U.S. stock market can be split up in a number of ways. And from an academic perspective and from a practitioner perspective, the ways that investors are parsing out the market today starts with looking at the size of the company. So when you look at these large, well-established companies that are in the S&P 500, those are usually called large caps or large companies because they're mature companies. They're very big. But it turns out there are about 2,000 other smaller companies in the U.S. market, which are actually on the way up, but they're smaller. So you have, a Columbia Sportswear, and you have, a Buffalo Chicken Wings, whatever. I mean, there are tons of these companies. Vail Resorts. There are tons of these companies that are smaller part of the U.S. market, but they're not in the S&P. And it turns out that if you look historically at the outcomes for investors in putting money into these two different groups, it's quite different. And we have a book here called the Matrix book. It's the big book of numbers. And he has some of this. And rather than percentages, I'll give you the growth of $1 in my dad's lifetime. He's 92, about to be 93. And actually he's 93, about to be 94. And $1 in his lifetime invested in the large company group of stocks was about $7,000. $1 turns into $7,000 in the S&P in my dad's lifetime, which is a remarkable growth. Now, the same dollar actually invested in small companies actually would have grown to about $27,000. So that's significantly more. So smaller companies, to begin with, they have more room to grow. They're riskier, and the investors demand a higher return. So that translates in a bigger growth. Now, among all these large and among all the small, not everything is the same. And if you split them up based on how expensive the companies are, because I mentioned a second ago that some of the companies are very expensive. Well, the low-priced one, like the example I gave was Intel and Pfizer, those are called value stocks because they have a low price for an accounting fundamental like earnings or book value and so forth. Historically have done better than the more expensive counterparts called growth. So when you look now at the distinction between value and growth, and you look at small kind of outperforming large over the long run, well, obviously the one asset class that would give investors the biggest bang for the buck over the long run would be small and value. And the growth of the same dollar over the same time frame in my dad's lifetime would have been roughly about 70. So the first thing that I would point out to people is that rather than looking at individual stocks, what you ought to do is really pay attention to asset classes. So now I'm going to actually get to your question. I don't know what the opportunities are. I think that every investor should have a very well diversified across the entire market, a portfolio diversified across the entire market. Now, the more you're willing to emphasize small company stocks, the more you're willing to emphasize value, you give yourself a chance to earn a higher potential growth on your money. So to me, the opportunity is to understand that there are times when large is going to beat small. There are going to be times when growth beats value. We know that's going to be the case. But historically, what we've seen is that value outperforms growth, small outperforms large. And what we're seeing right now is quite interesting. If you're going to look at this large growth, these large expensive companies, and ask, well, how much does it cost to buy $1 billion in assets left over after liabilities are paid? That's called book value. There's a metric called price to book that tells you pretty much, what's the cost of these leftover assets to buy for investors. And right now in these large growth is roughly about $10 billion. So you would spend $10 billion to buy $1 billion in assets from these large growth stocks. To buy exactly the same $1 billion in small value, when you look at the price to book, it would cost you, let's say, about 900 million. So it's about the price. It's all about the price. What I would look for opportunities today is just around prices. Where are the good prices right now? But that does not mean by any stretch of the imagination, take all your money and put it in small value, because there could be years when it underperforms. What I'm suggesting is, have an advisor look at the entire market and be very purposeful to know how much do you want to lean towards small, how much do you want to lean towards value. And to me, that's where the opportunity is for a long-term investor.
Apollo, I hate to say this, but it looks like our time is just about up. So before I ask you for your final thoughts, I do want to thank everybody who joined us today and for all your questions. They really did help steer the conversation. And Apollo, to be honest, if I had a professor like you when I was in college, I might have done a little better in economics than I actually did. So this has been a real learning experience for me, and I hope for all of our guests. Do you have a final takeaway for us, something for us to think about?
The final takeaway is that to acknowledge something that I started with earlier is that we right now are in a very I wouldn't say tense, but it's a very emotional time because of the pandemic and the impact on our own health and families, and because of the elections and all these things. And what we've learned over time is that investing is not just about the analytical look at the numbers, but there's a huge behavioral component. I think that this is a great time to talk to your advisor, make sure that the plan that you put in place, you understand it. You understand exactly what's in it. How was it built to withstand times like this? Because what you don't want to do is get carried away with emotions. That's probably the one thing that I would caution investors. Do not carry it away with emotions, whether you're excited about the election or you're anxious about it, whether you feel a certain way. I would trust in the market, that the market's analyzing this every single day. And beyond that, I just wanted to thank you, Michael and MSPC for the trust that he placed in us, and thanks to all of you for the trust. And I really wish everybody not only great financial success, but stay healthy, because this is a time when we should all be taking care of ourselves, taking care of other people, but ultimately, let's get through this all together in a safe, healthy way. Ultimately, that's the most important thing: is making sure that us and our families and our communities will see each other through this pandemic. But thank you for the trust and for the opportunity to be here today.
Great. It's been our great pleasure. Again, everyone, thank you so much for joining MSPC and our friends from Dimensional Fund Advisors. And if you have any further comments or questions, please feel free to either reach out to your advisors at MS Investment Partners or at MSPC. We'd be more than happy to get back to you. Again, Apollo, thank you so very, very much for your time. This really was a pleasure. And I wish everybody, happy, healthy, prosperous days ahead.